Welcome back to another StockTwits Q&A session. We're answering your questions live. I'm Brittany Umar, joined by Scott Red Dog Redler. We're going to jump right into it. Scott, you're actually on the radio this morning, and we've gotten a question saying that when the comments started coming out this morning and you were on the radio, you said you were adding to your spiders chart. How did you know that was the time to add?
Well, we came in this morning not knowing pretty much not knowing what to expect. Everyone was speculating on whether or not, the ECB would do something. Would Draghi back up his words? We all know yesterday Ben Bernanke came out, nothing changed. The market gave it a pass because I don't think everyone was really obsessing over that. The U.S. data has been light, but it hasn't been a disaster. And our stock market was basically 2 or 3% off the highs of the year. So they really didn't have justification to act. But as far as Europe, different story. Yields are through the roof, growth is slow, and there's really nothing that could actually help them except for central planning stimulus, bond buying, bringing their yields down. So today coming in, first we talked at, I think it was, 7:45. We saw that there was no rate change, which, really was no big deal. No one was really expecting it this time or maybe next time. And these low rates, already did what they can for the economy, even here. The Fed with the QE3, if they're going to keep rates low, anyone who could take advantage of low rates probably did it already. There has to be something a bit more creative and actually even more on the fiscal side. But anyway, as far as ECB, I said to myself, you know what? If they don't do anything, all right, basically, the market's not going to take it as lightly. They're gonna be selling this thing. So I came in with like 4 longs with the spiders short, and then all of a sudden I started hearing the word may. We may do this. We may do that. We possibly will do this. And right there, I actually tweeted, I think it was like a minute into it, I'm like, I heard, may, possibly, not enough. So, the spiders first, they had their little, push higher. And then as they started to fade, I just started adding to my spiders short when they went negative. You knew that 1375, the upper floor, which is why you're always prepared, would potentially break. And then, actually as we started to, make new lows and went down 100 or 100 and a quarter, I covered some because recently, pushing the bottom end of these ranges haven't worked because there's been really no momentum to the upside or to the downside. And, just knowing the language to look for, where we are in the chart, you put, the plan together, you connect the dots, and that's why you act fast, and that's how you stay out of danger, by connecting the dots with just a pre-organized plan. And my plan was if they do nothing, chances are we're not going to be able to sustain those upper levels.
Now, Bull Hunter says when it comes to the spiders, it seems we're stuck in the same channel and don't have any catalysts left. So he asks if you can take a look at the charts versus the markets in terms of moving catalysts. And he also notes that he thinks August is red always.
Well, August tends to be, a bad month, but a lot of people have also said that the summer tends to be bad. And what do? We put our low in June 4th. So anyone thinking that we're just going to fall apart during the summer, we actually fell apart in May and then bottomed in June. If you look here at the chart real quickly, back in the start of the second quarter is when we had this distribution pattern, this left shoulder, the head, the right shoulder. We broke this neckline, and that's when you had your measured move all the way down to the June lows. And then from June, we've been, like you said, in this methodical ascending channel. So the question is, you said August is typically, a weak month, and you would think that, you come back to me, with the Fed not acting and the ECB not acting, they're going to need their hand forced. They're going to need something crazy to happen for them to come out and be proactive, because actually they can be proactive. Today would have been proactive, and last night on CNBC Asia, I said, are they going to be proactive? That probably would be good, and they weren't. Now they're going to probably have to act when, Spain yields or Italy yields go through 8 or something new, some brand new high. Maybe people will talk about it. Or, a sell-off in the U.S. markets, as well as, worsening data. So that's why we have, the jobs tomorrow. So with that said, if you look at the chart today and you take away all the news, all the headlines, all the everything, and say, okay, are we in this same pattern or has anything changed? You look at the chart, and I put this on Charlie a few times. So far as of now, nothing really has changed. Here's your June low. From the June low, we went to the top of the channel. Then we came back down and held. Went back to the top of the channel. Then came all the way back down and held. Went not quite to the top of the channel, so it showed that we were a little weaker. And then what do we do here? Okay, this is when we breached this channel, and this is when Red Dog got net short, because I'm like, you know what, we're below this area. This time might be different. This time we might stay and come back and retest the 200-day, and that's when Draghi came out and said they'll do anything they could do, in order to keep the euro together, and pow, look at that move on jawboning, or whatever everyone wants to call it. So right now, look where we are. We're right back to this one trend line. I drew two trend lines because this is the first one that was holding us, and that's actually what held today. So I covered the majority of my shorts into this. I didn't press. Guys that pressed, were the same frustrated guys that pressed here, and that pressed here. So at this point, question is, will this be different? Will we just go from here back to the upper end? So we have to see, can this range hold us? Same way we needed to see if this upper area would hold for a move higher. Now we need to see, do we go sideways? Do we hang out down here for then what could be a potential break to the downside? So as of now, we have a new point of reference, right? We have 1354. And then you have, your more macro line in the sand, which held before, which is right here. And then I could also get into some Fibonacci retracements if we have any questions about that.
Well, ArtNet actually asks, he first says, thank you for the work that you did in the spider chart today. And he says, the trend line held, so what levels would you consider a breach?
All right, so let's go back to the chart. All right, first of all, it all depends on your time frame. So first, on me, before we go to the chart, because I want you to see my nice pink shirt. You see it? Everybody, pink. You like the pink?
I like the pink.
They're playing. No jacket today. I wanted to show off the pink shirt. It's summer. Anyway, it all depends on your time frame. I know I got a lot of slack last night because I was on CNBC Asia, and I said that the stock market, equities, would be a better place to be over the next decade, and to have a plan. And I also said that, there are two camps. One that says by 2015 we're going to be at S&P 1,000. And I'm on the other camp that I think by 2015 we'll probably be at S&P 1,700. So for a macro thesis, I know for me, probably for you, Brittany, it makes sense, to put money away every single month, and we will be okay over the next 10, 20 years in the equity market. I don't think the equity market's dead. I don't agree with Bill Gross. I don't think the world's going to fall apart. I'm a realist and an optimist, but I'm not a pessimist. But anyway, but besides that, so there are two ways to measure a breach and more of an intermediate direction, because I'm an intermediate trend trader. That's the way I try and, give a definition of myself, because as a professional, I want to play these trends and find the best acting stocks, get involved long with relative strength, short the ones that are breaking down in and off the charts. We've had a great example of the haves and the have-nots, and they've been working out. So if you go back to this chart of the S&P, you will see that, let's take away some of these lines, and you want to measure commitment, right? So a good way to measure commitment in this chart is by using your Fibonacci retracements. So now if you were using your Fibonacci retracements and you wanted to measure the commitment from the low to the high, okay, which is one way to do it, look where we are. Okay, all we did after all the media hype, everything going on, all we really did is, come down and test a level in between the 0.25 retracement and the 0.38 retracement. So right here, this still shows from this low commitment to this move. So on a macro basis, or even on an intermediate, if you got involved down here when we took back the 200 day, you have nothing to worry about. If you can't hold as long and you're a little, and so first of all, so going back to that, you could still get 1345, which would be the 0.38. So that right there, I think this would be a very key level, in my opinion. You have this 1343 area that would match up to this trend line, and that would also, mean that, this whole range is becoming weaker because we didn't hold here. But overall, you could still hold the 50% line, which is another support. So I would write down this 1345, 1330, and then the 0.618 is 1315, which is another key support. So here are your levels to identify each time. This one, which was today's low, 1354. Then you have 1345, which also is in conjunction to the trend line. So I'd say right here, though, as a momentum professional trader, if this line were to break, most guys would not be long. They would be thinking net short, that we're going to come back down and retest this area, retest the 200 day, and we could, tactically make a lot of money, on the short side, because we're professionals and we could do it. We're here every day. So, on a macro sense, though, this is the line, and we start breaking below this, all of a sudden everyone's going to be talking about retesting the lows. So, with that said, taking perspective and looking at this, we really haven't pulled back that much. So every bear in the world is going to come out and say growth's slowing, the world's falling apart, blah, blah, blah. P.S., look where we are. Doesn't, so at this point, I think you still need to participate if you're trading and you're a trader, you still need to look for some strong stocks, and I think you could also short some weak ones. And lastly, just to put a little whipped cream on this question or something like that, a cherry on top.
There you go.
All right. Some guys that are really short term, we're looking, we did this chart also in Charlie. They want to measure just the move from here because they think that this was a Draghi jawbone move, means nothing. It was all about that. So if that's the question, okay, you want to see the commitment to this Draghi move. And what do we do here? We touched the 61.8, which was about 13.55, which was also this trend line. So the move that took place from that Wednesday low to this week's high, comes in right around here. So if you're very, very micro, all right, this is your level to trade against, because if we break this, you probably rather, be short and then figure out if you could rebuy back here and not have to take, 20 handles worth of pain if you're that active.
Good stuff,
it all depends on the time frame.
Good stuff. Very detailed. Let's move on to Shylock D, who asks, what are your thoughts on IWM and IYT?
As I've made a lot of these forecasts for especially the longer term, people have been pointing out that the Russell is really weak, the transports aren't participating, and it's true. And right now with the growth slowing thesis around the world, growth, especially in the Russell, is not the place to be. And just the same way the industrials really haven't been the place to be. So, if anything's going to be weak, it's going to be stocks within that group. So by that being weak and being somewhat of a leading, because that's not really always a leading indicator, a really, really healthy market gets led by the Russell, gets led by tech. And I'm not saying we're in a very, very healthy market. I was saying we're in a choppy market that has been trending a little bit to the upside, and you shouldn't really sink your teeth into things because of all these headlines. So, we're in just a market that we're trying to figure some things out and make a little bit of money and get through this summer. But if you look at the IWM, it definitely is, a bit concerning, considering that this has already broke this, this uptrend, which the spiders haven't. So the question is, will the spiders follow or some of the other sectors? Here you also see, a series, or this was a wedge that broke to the downside. Then you also see a very, very wide range bar taking us all the way down. Here we broke the 200-day on the Russell, which is never a good sign. My rule, if you break below the 200-day, you have to get back above it within a few days. Otherwise, you continue, and it's not a trap. So at this point, the Russell is trying to bounce off this 76.22. So I would watch this level real close. And if it can't get away from it and take back just, say, a third of this bar, it will lead us lower, and this will be a group that's showing relative weakness that if you want to short something, you short this group first. So I would say 77.84, can't get back above there. You will get continuation to the downside, but as of right now, it's been a good short, a better short than other things, but it's not, you can't quite just hang your hat on the Russell. And as far as the IYT, it's been a choppy mess. It's still in this crazy, big channel. It also is coming back, closer to those June lows versus where the spiders are. And so if you're looking to short, look for things in here to short versus the stronger stocks. And there have been weaker stocks out there that go down a lot quicker than some of the tech names and some of the high beta names and some of other groups. So right here, you did get a green day. So what does that mean? That these two are the weakest groups. Spiders didn't turn green, and the transports did, and the Russell did. So I just think that we're not in a perfect environment, and the rules aren't exactly the same as they've been, and especially over the summer, and especially when you have every day a different event that's going to whip everything around. So just do a little less and just be a lot more precise. Even with today's down move, when we opened down, you could have bought Apple, it rallied $10 off the lows. You could have bought Google, it rallied $10 off the lows. Baidu went positive, eBay went positive. So if you knew the strong stocks and you wanted to create cash flow, even as the market opened down on the disappointment of that news, you could have made money tactically long. And then, and then once it went positive and you saw us roll over, you could have went short. So there's still ways to make money both ways if you have a plan and you just don't have, one side on the brain.
Now, Toronto Shark wants to know what's up with the VIX. He says the spiders were down over 1% while the VIX went down as well. Any insight?
I think the VIX is broken. I think it's a horrible gauge, and it's something not to be focused on. There are a few things. People say, you know what? The VIX keeps going lower because then you see this uptrend in play in the indices. We're going to continue. So there's no fear, and we're just going to keep going. And there are some guys who say, like me, that it just doesn't correlate. I don't think it's a good hedge. I just think that a lot of these ETFs are kind of built to fail, and VIX itself, it's just not the same animal that it was. And maybe this crash in the VIX is giving us some clues that tomorrow is going to be an up day in the market. Who knows? But at this particular point, just don't be enamored by the VIX, and don't think you could be long the VIX as a hedge to your portfolio. I'd rather see you do what I'm doing. I'd rather see you, if you want to be long 6, 7 stocks, short the spiders. So this way, like even today, I came in with 5 longs, I think, in a short of the spiders. Long good stocks. So when the futures were up and the news came out, I shorted more spiders. And then when we came in towards the open, I covered the spiders, got long some of the stocks that went green. LVS went green, Apple went green, Yahoo tried to go green. So it gave you a way to trade out of your strong stocks. So I created cash flow short the spiders, covered on some on the way down, bought some of the strongest stocks if I saw a relative strength divergence, and then when they bounced, I didn't chase them, I sold some. So I maneuvered my trading plan, but my trading portfolio, I guess, and moved on. So I would say if you're looking for a hedge and you want to stay with some positions on an intermediate basis, because some positions are acting well, you saw Target act well, some of the retail is still acting well, just have a hedge. And I think hedge it with the spiders, don't hedge with the VIX, because the VIX, you might think you're hedged and you have another thing coming.
All right, we're going to give Red Dog here a little break and bring in Laz for another point of view. But first, a quick commercial break. Keep the questions coming, and we'll be right back.
Hello, everybody. My name is Pete Renzulli, Chief Marketing Officer of T3Live.com. I'm really excited about introducing you to and inviting you to the first T3 Live Active Trader Summit. There's going to be a ton of great content, but the number one reason you want to come is you want to be able to network and associate with other like-minded people who have a burning desire to learn how to be a trader. So I'm going to ask you to make a trade. Trade one Saturday for some of your time to come down and learn strategies, tactics, techniques, and put some faces to the people that you see in the virtual trading floor in T3 Live, and learn to take your trading bigger. Learn how to be a better trader than you are now. Learn the strategies. It's going to be a lot of fun. Go to T3Live.com and register. If you would like to join us at the post-event cocktail reception, you can also upgrade to either premium or VIP. That's up to you, but either way, please take advantage of the general admission, 2 free tickets. Bring a friend, bring a neighbor, bring a wife, bring a girlfriend, maybe bring both, but come down and expect to have a great time.
We're back answering your questions live. Now I'm joined by Laz in a pretty awesome visor.
It's pretty awesome, right? Visors are not that cool, except when you're wearing them on StockTwits Live.
Yeah.
This is our T3 Live visor. I don't know if you can get a close-up on it, but this is what the triathletes will be wearing at the New York City Triathlon. Not this coming weekend, the following weekend. I think it's the 11th of August. A lot of traders. Scott's participating, a bunch of guys here. All getting out there, doing their best of exercise to raise some money. Just couldn't do it this year. I couldn't make the triathlon. I don't know how it happened, but listen, I'll be supporting you, and I'm supporting you right now. So cool little visor. And if you email me, Evan at T3 Live with the subject visor, then perhaps we'll send you one.
Oh, your inbox might just be filling up right as we speak.
Can't keep them on the shelves.
All right, well, I want a visor. But let's jump into the questions here. We have one for you from Ticker Traders saying, Laz, you heard you mention about the golden ratio. Can you please explain it?
The golden ratio. So the golden ratio, I mean, we can talk for a while about the golden ratio, but the golden ratio is one of the, it's really it's about harmony in the world, but how we relate to it as traders is really about harmonic movement in the markets. And the golden ratio is the 1618 retracement level. And let's take a look here. I'll put up a chart and we can kind of take a look at what I'm talking about. The significance of the golden ratio, the 618 retracement, whatever you want to call it, but it's basically a 62% forward and rear retracement level. So in Apple, as an example here, we can look at the an intermediate term chart or a shorter term chart, and you can see basically, and I'm going to use some fib retracements. Let's look at yesterday as an example. Why I think the 618 is so significant. If you look at yesterday's down move, which I'm highlighting here, so I'm basically highlighting yesterday's highs, yesterday's lows, and you can see that when stocks tend to bounce, 618s can be a magnet. You can see it bounced right here. See the 618? That's the golden ratio. A lot of times you're going to see stocks trade into those levels. Even again this morning, from yesterday's highs to this morning's lows, it rallied up 618. Now, it's not an exact price, but it's a level or an area where you can see change of events occur, and it's for really a deeper perspective of the golden ratio and the significance of it in both trading and in life. You can Google Fibonacci and the golden ratio, and you'll find plenty of information. But for those that are traders, I use this religiously in trading for actionable turning points. 618 tends to be a great barometer for changes or ebbs and flows in the market. And in the active trader class, we talk a lot about this, both in fib retracement theory study and in fib extension study, which is one being looking at rear price movement while the other looks at forward price movement. So if you're not familiar with the golden ratio and the significance of it and how traders can use it to help navigate, do yourself a favor, take some time and read about it if you don't take the active trader course.
All right, well, I don't know this can get involved, so maybe you can give us just a basic understanding of this. Cowhan wants to know how you can effectively use Fibonacci retracement to identify key levels for tactical moves.
Well, I sort of just answered the question. I mean, it's not something that I can get into because it would take a long time. I teach, this part of the active trader course regarding, fib retracements, fib extensions, and the study of Fibonacci methodology. And there's also time extensions and other ways to look at things. Again, it's all about finding actionable areas. It's all about having a plan. It's always about evaluating risk. I say it every week. Good trading is about understanding risk. And when you use fib, when you overlay fib studies into your trading, whether it's extensions or retracements, what you're doing is you're putting a methodology into place, and you're coming up with a plan for action, whether it's buying on a pullback, shorting on a bounce, or even where to sell a stock on, if you have a good trade and the stock starts to go up, where do I sell it and why? These are the things that I help traders understand. Why? And fib theory in itself is a great barometer to help answer the question why. Why am I selling here? Here's why I'm selling. It just hit its 1618 extension. Why am I, buying here? Just pulled back 0.618%. These are good low risk areas. And again, it's not all the time. It's not something that just works every single time. Things change and there's ebbs and flows, but more times than not, they're very actionable spots if you know what to look for.
Here's one from Shady Capital asking, when fading an overextended stock, what do you use to trigger your entrance? And he actually asks if you could use SolarWinds as an example, SWI.
Okay, well, let's look at the stock. It depends on the type of trade that I'm looking for. So, if I am looking at a mean reversion trade, if I'm looking something that's well off its 21 EMA that I think will give you maybe a 2 to 3 day counter trend move, I'm going to look for a buy setup on a 5-minute chart. I'm going to look for something that speaks to me about a low risk. How do I define my risk? And with SWI, again, I'm not necessarily sure what the trade would be here, as I don't really see that playing out yet. But to answer the question, let's go back to that Apple chart for a second, where you had, and Scott mentioned it this morning, you had this, extension here, this gap down. Let me take some of these lines off here just to make it a cleaner looking picture. This was a very good low risk type of long this morning off the open. Why? First move is down, it reverses, it takes out the opening bar high right here, and that presents a good formidable area for a low risk entry. So depending on the strategy, I'll look for mean reversion. But if I'm fading a gap down, if I'm buying a gap down or selling a gap up, I need to find something in the first 5 to 10 minutes of the day, usually that's a trigger or a catalyst for a reversal type of a trade. Let's go back even the day before, and we'll look at, let's say, right here. So right here, the day before, again, it's a trade I took where you get that gap up. Here's the 21, the stock gaps up. First move is impulsive down. You get a 2-bar bounce, and then that gives that second leg of the trade. So you need a setup in order to get good, a good fade type of trade. So whether I'm buying a gap down, selling a gap up, or I'm fading a market, I still need to have a visual structure that speaks to me in terms of how I can define my risk. And as opposed to just, a stock gaps up and traders naturally say, oh, I want to sell this, or a stock gaps down and traders say, I want to buy this because it's down. That's not a catalyst for a trade. You need something in terms of the movement of price that says, now the water is safe for me to be long or short relative to the trade, and here's the risk associated with it, and why. Why. So a fade is only a good trade if you can, again, identify the risk associated with it.
All right, Aloha Trader asks, could you clarify Tier 1 and Tier 2 in terms of a percentage of a portfolio? For instance, if you have $100,000 in trading capital, how big should Tier 1 be?
Well, I think it depends on what type of trader you are. It's not a question that's just a blanket. We can just say every trader should do 1% or 2% or some percentage of your portfolio. If you are a day trader, someone who is buying and selling consistently, rapidly every single day, for me, I generally, if I'm at max position, I probably would be maybe in upwards of 20% of my capital. But again, I'm a shorter term trader. I probably wouldn't put 20% of my capital if I was buying stocks for a longer period of time. So if you're working with $100,000 and I really wanted to get more aggressive with a trade, I would probably start and I would put on 5% of my portfolio, and then maybe I'd go to 10% and possibly as much as 20%, depending on the scenario. Every scenario is different. So some trades are, I'm going to go full boat. Some trades I'm probably only going to go, 2-tier. But I do it in terms of a percentage, and you really have to figure that out for yourself, depending upon your capital and your risk tolerances and the beta of the stock you trade. Some stocks will have, large beta, will have large movement every single day. So you have to be, you have to kind of consider all the elements before you just make a blanket statement. But I generally tell traders, for longer term traders, people looking at longer time frames, you don't want to risk more than 2% of your, portfolio on any one trade. That 2% rule, is kind of my line in the sand. 2% of total capital. But if I really like a trade and I want to get aggressive, I'll put on a substantial amount of my buying power.
All right, here's one from Manny Goodtimes. I like your name, Manny. Asking if KCG, Knight Capital, is the best hedge right now.
A hedge against what? I mean, a hedge has to be against something. So what is it a hedge against? I don't know I can answer that question appropriately unless I know what it is you're trying to hedge against. So
you want to take a look at the chart?
No, I mean, I know what the chart looks like, and we can even look at it. Knight's a stock that, it's a company that's fallen into some bad situations with some, erroneous trading errors, and there was chatter of bankruptcy today. So, this is a very news-driven stock. Is it something that I generally tend to gravitate to? Not really. Would I use it as a hedge? No, I probably wouldn't use it as a hedge against anything. So it is what it is. It's an individual company that's going through some turmoil. It's a very, emotionally driven trade. There's fear here. There's panic. There's not much I want to do with it. I don't necessarily think it's a buy here. I don't think it's a short.
I'm going to interrupt you because we actually have Manny chiming in right now as we speak,
right,
saying it would be a hedge against long Apple.
No. They're not correlated. There's nothing. No.
Negative.
No. Yes,
sorry, Manny.
The answer is no.
No good times for that.
No
Sorry.
No good times.
Here's one from Market Picker. What would be the best advice you could give to someone who's seriously considering a career in the active trading industry? Don't say don't do it.
No, I would never say that. I mean, that's big. No. I love what I do. I think the best, the best advice I can give somebody is have patience. I think from my experience, I know from my experience in working with, novice traders, people that want to trade, people that want to be in the business, people that want to do this, full time. The one thing that people don't do is they don't focus on the process. They don't spend time learning the process. Everybody, if I put 10, wannabe traders in the room and I asked all 10 what they want to do, they're all going to say, I want to make a lot of money. They focus on the outcome. And that's what traders, younger traders tend to do, is that they're so focused on making money, they never spend the time to learn a process in which to do it. So my one piece of advice to anybody seeking entry into the business or wanting to trade or wanting to do, along the lines of what myself and my colleagues do, is take time to learn a process. Take a year, take 12 months, 12 good months, and learn. Teach yourself a craft. You can't just expect to get involved with the market, open a brokerage account, fund it with money, and start trading. You are, failure for you, and again, I'm speaking to the masses. Failure, from what I've seen, it's not a question of if, it's a question of when, because you're so focused on the outcome, you never really learn a process. And that's the biggest piece of advice, and the reason that we wrote the Active Trader course was to fill that void. Learn a process. Take the knowledge from in our heads and apply it. Learn to apply it. Learn to make sense of it so that you can ask that question, why? Why am I long? Here's why. Why am I short? Here's why. What's my risk? Why? What's my target? Why? Why? And the people that answer those questions, and they answer them succinctly and soundly and confidently, are the ones that percentage-wise have a much greater percentage chance of success.
All right, Laz, well said. And that's all the time we have with you today. Any last words?
I just want to thank everybody for last week. I was here with Mike Lee, and we rolled out Momentum 2.0, and the effect and the feedback, and it was going off the cakes like not like my visor, but I just want to thank you. It was really an amazing response from that momentum promotion. And if you haven't plugged yourself into it, go to t3live.com and you can read about it. But just a thank you to everybody for making that just a tremendous success.
All right, and on that note, we're going to take a quick commercial break, and we'll be back with the Red Dog. Keep the questions coming.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders to understand how to develop an edge in the markets so you can put your money to work with confidence. The T3 Live approach includes a mix of training, trading, and technology to help you learn to recognize, adapt, and ultimately take advantage of different market conditions. So what actually separates T3 Live from other educational firms? For one, transparency. We show all of our positions live, so there is no smoke and mirrors. Basically, we put our money where our mouth is. We have to because we're regulated by the SEC and the Chicago Board of Exchange. Number two, we're real traders. You'll be learning from real professional traders that make a living trading their own proprietary trading accounts, not just instructors that don't trade. Your goal should be to associate and learn from big traders who can teach you how to take your trading to the next level. And three, credibility. Millions of people turn to places like CNBC, Wall Street Journal, Fox Business News, and these outlets actually look to T3 Live for information. No other educational firms are asked to be a consistent contributor. We at T3 Live would like to get you started with a step-by-step method that has been proven over time. The same blueprint for success that I've gone through. It's not a weekend seminar, it's an approach, a mindset, a process to show you how to take control of your financial future. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our Foundation 30-day online home study course. The reason I'm willing to give you such a valuable course for free is I'm sure that once you complete the program, you'll want to continue your education with our team. All you have to do is fill in your name, email address, and I'll see you on the other side.
We're back answering your questions live. We've got Red Dog back with us. Welcome back, buddy.
I'm just coming back from off the cakes.
Let's just jump into one from Evan English, who says, yo, Scott, thanks for giving so much to all of us traders. Do you think we get a chance at an Apple swing price below 600, 590, 580? You're the best, he says.
Oh, thank you very much. Well, I hope not, because I'm actually long Apple right now. But I would like to buy more. It all depends on how it's going to happen. So if we were to reach some of those prices you listed, then we're in a very soft tape. So as of right now, it feels like Apple is being one of the chosen ones again. This morning with the futures down 8, 9 handles, you could have bought it at that gap and made for yourself 7, 8, 9 points, whatever it was, for cash flow. But if you're also looking to do it as a swing and hold it, you look at the chart here, there's not a lot to be upset about. So you go to the chart, we all know what happened with earnings. After earnings, because of the push out in the iPhone 5, you had to move down. The low here was 570. It was, brushing against big support. I tried shorting it, guys tried shorting it, wouldn't go down. So if it's not going to go down, it was a better buy. It didn't have any more downside there. So this was your entry right here at 580.80. We listed that a few times. And then you had that 4-day move. And if you remember, I think it was yesterday, it opened up right into this resistance. And it was finally a nice tactical short. So if you trade for cash flow, another nice little move. So if you want to take a step back and see where we are now, the question is, can it hold this upper level? Can it go sideways, build an upper floor? Because if it does, and if this low area, today's low was 600.25. 2 days ago, the low was 602. Yesterday was 603. If it holds this area, you're going to see a lot of pent-up momentum, and then we're going to get another really nice trade through 617, 620 to take us back to the highs here. So this right here is if you're going to be long, any stocks out there, there are only a few select strong ones that I think you can get away out of. I think Apple is one of them. I'm still long overnight. I think that if we get a bad jobs number and we gap down, that's one of the few stocks that you could trade around. You could trade out of it because it typically likes to fill its gap. So if you're in the right stock and the tape goes against you, there typically is a way to salvage it. At this particular point, the earnings gap was filled. We're holding higher. We're above the 8-day, above the 21-day. As long as there's no news that all of a sudden the September date for the iPhone is really not the date and it gets pushed to October, I think that the stock is going to act fine, and we should see new highs at some point, going into the end of this year, if not the first quarter. Actually, no, I would say well before that. So right now we have our pivots. We have price points to trade against. And just one more time at this chart, either you buy versus level, okay, into support, which in weak markets is better to buy the dips and not chase. But if today's low is the low that sticks, which it would be pretty crazy, I think that this trend line is going to break to the upside, and you could add above 617 to 620 and a close above 620. Your real next point of reference is right there at 644.
All right, we have a couple Red Dog reversal questions for you.
Okay.
Let's start with one we just got in from Cowhand asking, he's long Starbucks and wants to know if a Red Dog reversal is still in the making here.
It was, and it didn't close really well, so there is no Red Dog reversal here. Okay, sometimes you could cheat a little bit, and a lot of guys made money because when we talked about it, it was off the lows, like 50 cents off the lows. In my head, I think it was 43.70. I'll get to it. It actually traded through it and went another 50 cents, and some micro guys made some really good money cash flow wise. And if you remember, I tweeted a few times, I'm like, if you're going to see commitment, it should hold here. If you're going to see commitment, it should hold there. And then once it went to as high as 44, it should have really held that 43.70 in order for it to have been really strong and shown you a reversal, setup. Because if you look here now at Starbucks, it really didn't give you, I'm still long a little bit at Starbucks overnight. It didn't give you the setup where it closed back above this 43.70. It tried, it came below, came back above, buyers came in, but then it failed. So maybe it'll do it tomorrow where it goes below 43.04, makes a new low and comes back. So at this point, it's still like dripping to the downside. But if you look at your 5-minute chart, let me just give you my rationale right here. This was a really nice trade. For some guys who weren't looking to swing it. So sometimes that's why I say the Red Dog reversal is a good cash flow trade, and sometimes it's a longer term type of swing trade. Well, here is when it put that low in around 9:30. Okay, this is when I was like, okay, this has the making for a reversal. Went back up to, it actually had this nice quick move to the old resistance, which is like a little bit of a downtrend here. So right away, it came up and you saw commitment. So if you look at this little move to the upside, it was holding here. So I think I got involved right around here, right around like 43.40-ish on this second bar. Came up, and then this dip was buyable. And then finally, it triggered above that 43.71, and it gave you a move to as high as almost what? This was 44.18. And then really, if it was going to be great, it should never have came back below this. It should have held higher again, and it should have went up, went sideways, went up, flagged and continued, but the market got weaker also at that point, and it failed. So this last little flag type pattern right here, if you were trading it on a micro sense short term, once it went back below 43.71-ish, this was your stop. So you could have been stopped out right there. So then again, another small little pennant type pattern here, and then it pushed lower. So this was really the ending of that trade. From here to there, nice, higher highs and momentum. This is when the momentum failed, and then it just became just another trade and not really a swing. The one thing I will say is the market did make new lows, and we never went below the low that was put in here at 43.04, and then we closed off off the lows. But overall, it really didn't give you much thereafter. So it was a quick pent up move, which is something you could find every single day in every single chart, no matter what goes on. And this is how you make tactical cash flow if you have that set up. But then it really didn't turn into much more of that as it closed, near the lows of the day, and didn't give you that, that reversal capitulation / close above the previous day's low to mark some type of release on pressure.
Well, while we're talking about Red Dog reversals, let's answer BF Trader, who asks, Mr. Dog, what do you think? Oh, isn't that great? What do you think of entering Chipotle? I'm trying to understand your Red Dog reversal.
Okay, this one was a little stronger today. It showed some relative strength. If you go to the chart here, I wouldn't quite say this is you know, a red dog reversal, but you see a green bar here. You know, it's been, you know, a big move to the downside. You know, we talked about when trends change and how you leave momentum stocks, and this is when this trend that it's been following all the way back from November changed. It broke, retested, you know, couldn't reclaim any of it. Then you had the big gap after earnings, and now it's just like slowly dripping lower. I wouldn't, you know, I guess it went, I didn't watch it today. I guess it went below your 280.41, hit a low of 277. So if when it came back above, that was your buy price with a stop at 277. So, you know, right there, your risk was about 3 points, and then it did close. Where did it close? 283. So you could have made 3 points. This chart doesn't really excite me. It was good for a cash flow trade. You know, I wouldn't quite say a red dog reversal. It is descending. It could continue like this for a while. I would say it's going to have to break this, to retrace a little bit of this move. At this point, a little relative strength. It's broken. I don't know if you took it overnight. If you took it overnight, okay, but make sure that this is your stop. I'll try and show you a little bit more of if there is, like here, this is a red dog reversal. Let me show you a little bit right there. Okay, so here, if you look at the chart pattern from the low here, this was from 270, had a big move all the way up to about 340. So what is that? About 70 points. And then, you know, you had buyable patterns where, you know, this was the last downtrend it broke. And then here is when it pushed through the old high, squeezed everybody out of their short, because definitely people were trying to short in here, and, you know, got everyone out above 338, went as high as 346, and then closed below the previous high. So it squeezed out shorts. Okay, let me even make this a little bit bigger for you so you could see it. So squeezed out the shorts that was shorting it and trailing it the whole way up, and then anyone that chased it, you know, and bought it was like, oh my goodness, I just chased this up 70 points. So you short this with a stop at the high, and, you know, it wound up being a good day trade. I guess this day kind of pushed the envelope, but this is why you also honor your stops. Those who said I'm not going to cover unless it breaks above this day's high held through whatever this pain was, and then you wound up having a move, you know, down about what was this, 30 points. So the high here was 346. Your entry was 338. So you had 8 points was your stop, and it wound up yielding, you know, a move all the way down to here, which was, you know, a big risk-reward type move. So that's the way you try and find the counter-trend move that could be just a day trade, but if you just leave your stop in there and say, beat me, it could turn into something a lot bigger.
All right. Cashflow Trader asks, Red Dog, where does LinkedIn go tomorrow?
Well, when I came in, it's been getting pressure because of Facebook. I think everyone's trying to short it because they're like, if Facebook's going below 20, LinkedIn's got to get crushed too. The whole social mess, the Groupon, the Zynga, the this, the that. But I've said it many times that I think LinkedIn is different. LinkedIn has a business model. They're now, you know, this is the third quarter in a row that they've beat the estimates. You know, they're making money, and their valuation when they came public wasn't astronomical the way they did with Facebook, $100 billion valuation on $4 million in revenues and $4 billion and $1 billion. It just, you know, it valued actually Apple. That would have been like a $2,000 stock under the same metrics. But anyway, you know, so it's been getting beaten up because people are scared. You know, Facebook can go below 20 and all these social media stocks are getting crushed. You know, LinkedIn is in that group. So if you looked at the chart of LinkedIn, it's been definitely hard to hold. And at this point, you know, you look at the long-term chart of it, it's still hanging around. It closed near the 200-day. You know, I guess there are easier things to own. And I remember when it broke below 101, I'm like, if you're not committed to LinkedIn with everything that's going on there, you could get out and wait for a time that has a bit more clarity. And then this is when it broke. At this point, I think after hours, I saw it trading above 100 when Laz was speaking with his cute visor that I'll be wearing on the Ironman. And then when I came in here at the end, it was like a 97. So I think whatever goes on, they're trying to just sell these, and people are scared to own them. So for me, I'm avoiding for now until we get some more clarity. Let's see how it really acts tomorrow, if it could hold up. It held the 200-day, but tomorrow, if it opens up around 99 and they sell it, I would just say get out of the way and wait for more clarity that there could be easier things to own out there. Technically, you still have, you know, the shooting star top right here, you know, where it came up, dojied, and then traded below, and ever since it has had a hard time getting through 110. We've talked about above 110, that's when momentum could kick in, and if you hold above there, we could see new highs. At some point, I guess when the group gets its act together and the media stops beating everybody up about it, and you have guys on TV that have private guys involved at 31, 33, made their clients buy it at 42, and now at 20 they're saying it's not a real company. They're scaring everyone to death. So there's going to be a time when these things start to maybe act better, and when that is, LinkedIn is definitely the leader of that group, and we'll trade it accordingly. But for now, I think it's a tactical trade, and if you're going to own it, it's just going to be a little bit tough. And if it breaks, and if it doesn't go up tomorrow on their earnings and guidance, I'd be very careful.
Okay. T. Lang says, what do you think about Priceline, which was up huge last Friday and gave up most of the gain this week?
Priceline is one of the high beta names I do the worst with. I don't really love their business model, and I don't believe in their valuation, but it's one of those that doesn't go down that much. As far as Priceline, to me, I think it's vulnerable. I think that it's lofty. It's still above the 200-day. You still have earnings to come out. I know it got, when Trip came out with their earnings, a lot of shorts got scared. There's a lot of shorts in here, and now we're right back down to here. I think keep trading it intraday. Don't try and guess whether or not it's going to get crushed, because every time people do that, they get hurt. Last time it had a channel here. It broke to the upside. Now, you have a double top peak, and we couldn't take back half of that. So I would say technically it's a little bit more faulty than it's been in the past. And I just don't think you need to be long or shorted into earnings. I think that once the number comes out, you trade it after hours, and after hours, if you know the levels and you know what they're looking for and you know what the whisper is, I think you can be just as successful without getting screwed on the premium, by the option guys, jacking you up, and by trying to, pick a which way to go. And at this point, it's been a big winner, and I just think it's vulnerable. And every year, some of these stocks get vulnerable. 2 years ago, we had Netflix, you had GMCR. This year, we talked about it happening to CMG and a few others. So this one, in my opinion, is one of those vulnerable ones. So just be careful.
All right. Well, that's all the time we have for questions today. Scott, any closing thoughts as we head into the last trading day of the week and jobs tomorrow?
I would just say, again, have a plan and know your time frame, know what you can handle. I tried to show you guys the charts of the S&P and that ascending channel. And all in all, if you take a step back and look at the macro charts, we're still holding them fine. I feel like they've thrown the kitchen sink at the markets. Everything that's gone wrong in Europe, it continues to go wrong, and there's been no fixes yet, and we're still, hanging out in this uptrend. As far as people saying that the equity market's dead, I don't think that's the case. I think you can make money finding the best stocks, long and short, and if you want to do something monthly, I do think you could do some type of money management program where you put your money in every month in an S&P fund. If you're not paying attention, and over the next 10, 20 years, you're going to do better than having it sit in cash and in the bank. But if you're a professional trader like us and you're looking for cash flow and you're doing intermediate trends, try not to anticipate right now and try not to get caught up in the hype, and just don't do anything dangerous. Yesterday, case in point with Knight, we all know what happened with Knight. We know the blow up there. We saw the algo situation transpire where all these stocks were out of sequence, and seasoned traders that actually aren't automated, that use their hands, were able to see that Deere shouldn't have been up what it was up, Colgate shouldn't have been up what it was. Bungie, people are like, Redler, why are you short Bungie? I'm like, I've never seen this before. So guys actually were able to make money there. Then we talked about, at $9, like, what? They're probably gonna have to take the losses. It's a decent short, and guys made money shorted. And then at the end of the day, people were trying to guess, oh, should we be long? Should we be short? And should we sell puts? I'm like, you know what? This is a dangerous spot. If you sell $5 puts and it's at 7.5 and you want to collect your $2, it could be at 3, and you could be put the stock in today close at 2. I'm like, anything could happen. So if you're going to be involved in a situation where anything could happen, you better have the risk. I'd rather let those crazy situations, go get kicked to the curb, even though they could be profitable. If you're going to do something, do it intraday, because intraday at least you have more control. So there are a lot of landmines out there. And what I would do if I were you is just stay away from the landmines, stay away from the tough money, try and find the best setups, try and be very specific. And if you do so, once the environment gets a little bit better, we'll be able to, be a little bit loose, hold multiple positions, add on breakouts, sit in them like we did the first quarter. Remember the first quarter? That was fun. Holding 13 to 15 stocks, adding tiers as they break out, high-fiving, having the best quarter, sitting tight, low volatility. That's great. granted, we also love when it's crazy volatility and the markets get crushed because we love to short also, and stocks go down a lot faster than they go up. But right now we're in this methodical, choppy, ascending channel where you can't buy highs. You have to sell them when they look good, or when they look bad and you want to short more, you cover, and that trend's intact until it changes. And once it changes from an intermediate trend, we'll tell you, and we'll try and trade from that trend, and hopefully we won't get any big news blasts that that change things. And that's very hard. In a news-driven tape, I think cash is king. Do a little bit more intraday than holding overnight. Piece it together, lower your expectations. Some smart guys out there say low gross, low net when you're not seeing it, and just tack the green days together. So this way, when things are a bit different and easier, you could make a lot of money. And a lot of people's traders, like as a trader, most of your year is made in 3 to 4 months. So, so if it's in 4 months, the other 8 months, you make a little and you don't lose a lot. And then in those 4 months when things are going and things are breaking out or breaking down and you could press, that's when you make your money, because you're not going to make it every single month. You're going to make it in 3 to 4 months over the course of the year, and wait for those months. And don't be in a big hole for when those months come, because it's excuse my French, it sucks when you have to make a lot of money back because you were undisciplined, you got frustrated, and you put yourself in a hole. So you're better off just taking it easy. And if this is one of those times, it's August, go enjoy yourself. Go do an Ironman, and don't bang keys or break keyboards.
All right, good stuff. Thanks, Scott. And thank you guys for all of the great questions. Meet us here next week. There it is. Have a great night.